everybody. It's Jessica Stone at Stansberry Research, along with James Early, the CEO of Stansberry China. And James, I want to talk to you today about the fact that there's 4 Chinese companies listed on the New York Stock Exchange. They're all accused of fraud, and yet there's already U.S. law that's supposed to prevent fraudulent companies from being listed. I mean, think WorldCom and Enron. How did we get here?
It's a great question, Jessica. The quick backstory is after those frauds at WorldCom and Enron, we had Sarbanes-Oxley Act, which is investor protection. And basically, not only do public companies trading in the U.S. have to be audited, but those audits have to be audited or able to be audited. And every other country where we have a foreign company trading in the U.S. allows the Public Company Accounting Oversight Board, which is connected to the SEC, to audit, except for China. And we've basically been making this exception for 18 years.
What are the U.S. government's options here to prevent fraudulent companies from listing, especially those outside the country?
Actually, just before we were talking, I was looking, Jessica, at the PCAOB website. I'm going to show it here in a second. You trust me what I'm saying, but it lists all the companies where it's tried to audit but can't. And essentially, they're all in China. Two are in Belgium. But basically, China's just not playing ball. So the U.S. could say, look, maybe as part of this trade deal, you have to do this, or maybe we just refuse. Marco Rubio and some on the more conservative side has said, look, if you want to list in the U.S., you got to play by U.S. rules. That's sort of the hard line. But one thing to clarify here is this is not done just as an appeasement to China. That may have been part of the idea, but it's also to allow U.S. investors to invest in Chinese stocks, and there's relatively high demand, at least among individual investors in the U.S.
And I mean, some of them are fairly heavily invested, at least in the big Chinese companies like Alibaba.
Yeah. Alibaba is very heavily retail invested. It's more than half retail ownership compared to Coca-Cola, which is only about 25%, is even a smaller company. So it's a lot of retail investors. A lot of them would be angry. Technically, if a stock gets delisted from a major exchange, it usually can trade on what's called the pink sheets. This is over the counter. It's not technically an exchange. So that's one option. However, the U.S. government could say, no, we don't want these stocks trading anywhere in the U.S. In that case, it gets a lot more complicated. Do you have an investment bank buy back the shares and then transfer them to China? Maybe they suddenly own shares of the company as it trades in China or Hong Kong. I don't think they totally lose their money, but there'd probably be some weird workaround and they would probably lose a chunk of that value.
Now, China has responded. The Chinese government has actually responded with their concern about this problem because obviously it's kind of a black eye diplomatically. What are the chances that that creates some change?
Well, there's a little bit of a positive energy here in that 10 years ago, we had about anywhere from 100 to 150 reverse merger frauds, fake Chinese companies that kind of snuck onto U.S. exchanges. In those cases, the Chinese government didn't punish them and, in fact, protected some of those fraudsters. In this case, we have the CSRC, the China Securities Regulatory Commission, the SEC of China, basically, coming out and basically putting out negative tweets. It's on Weibo, so it's a Chinese version, against these frauds. So finally, they're acknowledging it. They know it's a reputational risk. So they're not actually doing much yet, but at least they're making announcements that it's a negative thing.
So this really isn't good for the Chinese or the American exchanges, especially the U.S. exchanges that have been hosting these companies. So I'm wondering if there's a sort of private sector response that could be had. For example, you and I have talked about how the Shanghai exchange is very difficult for these Chinese companies to get on. It has a very high bar. What are the chances that the New York Stock Exchange or the NASDAQ could set its standards at the same level and say, look, if you want to be on our exchange, you need to meet the same requirements that you would have to meet if you were going to get listed on the Shanghai exchange?
Yeah, I think that would certainly work. The question is, then that suddenly sounds like reverse favoritism, and we're going to get some pushback. But you can bet the exchanges are going to be a lot more concerned because they lose face over this too, Jessica. They don't like how they look, and the investment bankers also look bad too. So hopefully this is another wake-up call. Maybe we need one about every 10 years.
Well, we'll see what happens, James Early. Thanks for joining us. And if you would like to see more content just like this, please subscribe to our YouTube channel, which is at the link below. And you can also follow us on Instagram, Facebook, or on Twitter. Thanks so much for joining us. That's all for now.